Hello, everyone. In this lesson, I will cover foundational topics in international finance. Let's begin with a clarification of what sets international finance apart from domestic finance. What sets apart international finance from domestic finance is that sovereign nations have the right to issue currencies, formulate their own economic policies, impose taxes, and regulate movements of people, goods, and capital across their borders. As a result of this, there are four major dimensions that set international finance apart from domestic finance. We start off with foreign exchange risk. Foreign exchange risk, also known as currency risk or FX risk in international finance, refers to the potential for financial losses due to fluctuations in exchange rates between different currencies. When a company or investor is exposed to multiple currencies, such as through trade, investment, or financing, changes in the exchange rate can affect the value of cash flows, assets, liabilities, or profits. So, why does foreign exchange risk matter in international finance? Well, first factor is profit margins. Currency movements can erode or boost profit margins. Next factor is investment returns. Exchange rate changes can significantly affect returns on foreign investments. Third factor is debt repayments. Firms with debt in foreign currency may find repayments more expensive if the domestic currency weakens as compared to the foreign currency. So how do we manage foreign exchange risk? Well, we can manage foreign exchange risk by using hedging instruments, for example. So examples of hedging instruments would include forward contracts. Now, forward contracts simply lock in an exchange rate for a future date. So you lock in the exchange rate today, and that exchange rate locked in is applicable at a future date. You can enjoy that locked rate at a future date. Then we have options, which is also an example of hedging instruments that can be used to manage foreign exchange risk. Now, options give the right, but not the obligation to exchange currency at a set rate. So at that specified rate, one has an option to pretty much exchange currency at that rate. It's not an obligation. You may choose to exercise the option or not exercise it. The last hedging instrument we'll talk about is swaps. And swaps are agreements to exchange currency flows over a period of time. Now, other than hedging instruments, one can also use natural hedging to manage foreign exchange risk. And in natural hedging, we match revenues and expenses in the same currency. So for example, producing and selling in the same country, right? That becomes a natural hedging strategy rather than producing in one country and selling in another country, which exposes a business to foreign exchange risk. And third approach to managing foreign exchange risk will be diversification. And in diversification, we simply spread investments across multiple countries and currencies to reduce the exposure to foreign exchange risk. Let's now turn our attention to the second major dimension that sets international finance apart from domestic finance, and that is political risks. Now, political risk is in international finance, referencing the potential for losses or negative impacts on investments or business operations due to political changes or instability in a country. This type of risk arises when political decisions, events, or conditions affect the profitability or viability of an investment or financial transaction. There are 6 types of political risk I'll touch on. The first is expropriation and nationalization. And here, a government may seize or nationalize foreign-owned assets without adequate compensation. The second type of political risk is policy changes. And this would include sudden changes, for example, in tax laws, labor laws, environmental regulations, or trade restrictions that can harm business operations. Third political risk is currency controls. Governments may impose restrictions on currency exchange or capital movements, thereby affecting repatriation of profits. The fourth type of political risk will be political violence. This includes civil unrest, terrorism, war, riots, and other such events that can disrupt economic activities or destroy assets. The fifth political risk will be regulatory risk, and this would include new or unpredictable regulations that can increase costs or prevent companies from operating effectively. And the sixth and last political risk I'll touch on is corruption and bureaucracy. Now, excessive corruption or complex bureaucratic systems can impede investments and increase operational costs. So what's the impact on international finance as a result of these political risks? I'll start off with foreign direct investment, FDI. Investments, or rather investors, may hesitate to commit capital to politically unstable regions. So this will be a direct consequence of heightened political risks. Next impact is exchange rates and interest rates. Now, political uncertainty can lead to currency depreciation or increased borrowing costs. And next impact will be on the cost of capital. Now, higher perceived political risk increases the risk premium demanded by investors, thereby raising the cost of capital. And the fourth impact on international finance will be insurance and hedging. Now, companies often purchase political risk insurance or use hedging strategies to mitigate political risk exposure. Now we move on to the third dimension that sets international finance apart from domestic finance, and that is market imperfections. Now, market imperfections in international finance refers to the real-world deviations from the assumptions of perfectly competitive and efficient markets. These imperfections create barriers to the free flow of capital, goods, and services across borders, and they significantly affect decision-making for multinational corporations and investors. Now, the key types of market imperfections would include transaction costs, where we have items like brokerage fees, bid-ask spread, taxes, and administrative expenses. Now, these costs reduce the efficiency of international finance transactions. Next, legal and tax asymmetries. So different countries have different legal systems, tax rates, and regulatory frameworks. These differences can distort investment flows and corporate behavior. The third key type of market imperfection is information asymmetry, where investors and firms may not have equal access to accurate and timely information across countries. Number four, that's the fourth type of market imperfection, is government controls and restrictions. And this would include capital controls, tariffs, quotas, and foreign exchange restrictions. Now, these policies can limit or distort international trade and capital flows. The fifth type of market imperfection is political and economic risk. And here, instability in a country can affect investor confidence and distort market outcomes. Risk premiums may be demanded even when economic fundamentals appear strong. Sixth market imperfection will be differences in corporate governance and accounting standards. Now, inconsistent financial reporting and governance practices make cross-border investment evaluation more complex, and this may result in higher perceived risk or misvaluation. And the seventh and last market imperfection type I'll touch on is limited market access. Now, some investors or companies are excluded from participating in foreign markets due to legal, institutional, or financial barriers. Now, this can prevent full integration of global markets. And we now turn our attention to the last major dimension that sets international finance apart from domestic finance, and that's expanded opportunity set. Now, the expanded opportunity set in international finance refers to the wider range of investment and financing options available to individuals, firms, and institutions when they operate globally rather than solely within their domestic markets. So let's look at an example of expanded opportunity set. Let's take a US investor who only invests in US stocks. Is limited by the performance of the US economy. But by investing in global markets, such as stocks in India, Germany, or Brazil, they can potentially achieve higher returns and reduce portfolio volatility through diversification. Similarly, a multinational company can borrow in Japan at lower interest rates and invest the capital in a high return project in Latin America, taking advantage of different financial conditions globally. The expanded opportunity set is one of the main advantages of international finance. It allows investors and firms to make better choices, manage risk more effectively, and seek higher returns by not being confined to domestic markets. Let's now review an example of foreign exchange risk. So here we assume we have $1,000 that we invest in 50 shares of Toyota stock at 2,000 yen per share. And we assume that 100 yen equals $1 today. So that's the spot rate. $1 is worth 100 yen. And we've invested in 50 shares of Toyota stock at 2,000 yen per share, which will mean that we've invested 100,000 yen, which is the $1,000 we had to invest. Now, 1 year later, the share price has increased by 10%, which means in terms of yen, the 100,000 yen investment in Toyota shares would have increased to 110,000 yen. However, if the yen has depreciated such that 120 yen is now equal to $1, again, if the yen has depreciated such that 120 yen equals $1, let's see how much the investment that has appreciated in yen terms by 10% is worth in dollar terms. Now, the 110,000 yen, when converted to dollars in a year's time, with the yen depreciated to 120 yen to $1, will mean we'll need to divide by 120, right? Because that's the rate at this point, right? So once we divide by 120, we get $916.67. So in dollar terms, the investment has actually declined, though the share price of Toyota stock actually increased by 10%. The exchange rate movement has wiped away that increase in the share price of Toyota stock and has even caused a drop in the original $1,000 value to 916.67. And this is a clear example of how the exchange rate could move in a direction such that the investment made has declined in value. We will now discuss the evolution of the international monetary system, which forms a critical component of international finance. Note that a good international monetary system should provide sufficient liquidity to the world economy and safeguard against the crisis of confidence in the system. Now, historically, we have the gold standard, and the gold standard is a system where the value of a country's currency is directly linked to a specific amount of gold. Under this system, money can be exchanged for a fixed quantity of gold, and governments or central banks are obligated to convert paper money into gold upon request. The amount of money in circulation is limited by a country's gold reserves. So, key features of the gold standard, which was used historically, is that central banks held gold reserves to back their currency. And the gold standard was applicable from late 19th century to early 20th century, and it was most prominent from 1870 to 1914. Next, let's look at the Bretton Woods system. Now, this was a post-World War II system where currencies were pegged to the US dollar, which in turn was convertible to gold. So the key features of the Bretton Woods system were as follows. We had institutions like the IMF and World Bank being established, and the Bretton Woods system actually was in use between 1944 and 1971. Now, the key advantage of the Bretton Woods system was that it encouraged international trade and stability. Now, on the downside, it resulted in the overvaluation of the dollar, and US balance of payments, rather, were in deficits. So we had US balance of payments deficits. And eventually, the Bretton Woods system collapsed in 1971. Now, with the end of the Bretton Woods system, we had the suspension of gold convertibility. And this marked the end of the fixed exchange rate era. Now, as far as floating exchange rates are concerned, so again, with the eventual collapse of the Bretton Woods system, we now had floating exchange rates where most major currencies gradually shifted to a floating exchange rate system where currency values are determined by market forces. And then we have increased global monetary volatility, where without the fixed exchange rates, currency markets became more volatile and subject to speculation. And then we also had the rise of the fiat currency era. So the US dollar and most other currencies became fiat money, not backed by a physical commodity, but by government decree. So let's be clear about what a fiat currency is. It's money that gets its value from trust in the government and economy, not from any physical substance such as gold. It's a standard form of currency used worldwide today, and it's enabled by modern central banking systems. All right, so there is no intrinsic value in the money. The paper or digital currency itself has no value outside of its use as money, and it's not backed by a commodity such as gold. So unlike gold-backed currencies, fiat money is not exchangeable for a fixed amount of a tangible asset. So with the end of the Bretton Woods system, we have the floating exchange rate system, we have the currency peg, we have a currency union, and then we have the dollarization or euroization. So let's start off with the floating exchange rate system. Now, this is a system where currency values are determined by market forces without direct government or central bank control. So the key features would include exchange rates fluctuating based on supply and demand, with central banks occasionally intervening. And it's this monetary system, that's the floating exchange rate system, is in use post-1971 to present for many countries. And one of the key advantages is that it facilitates flexibility in monetary policy, and there's automatic adjustment of trade imbalances. Now, the downside is that there's exchange rate volatility, and there's potential for speculations or speculative attacks. Now, let's look at the fixed exchange rate monetary system, or the currency peg. So here we have a system where a country's currency rather, is fixed or pegged to another major currency like the US dollar or euro. So the key features of the currency peg monetary system is that the peg may be rigid or within a band. Now, it requires significant foreign reserves to maintain the peg. Now, examples of countries that use the fixed exchange rate or currency peg would include Hong Kong, which has its currency pegged to the US dollar. And as far as advantages and disadvantages are concerned, in terms of advantages, there's exchange rate stability, and it's good for trade and investment. Now, on the downside, there's vulnerabilities to speculative attacks and limited monetary autonomy. Let's now look at the currency union type of monetary system. And here, a group of countries adopt a shared currency and a common monetary policy. And the key features of this monetary system includes a single currency managed by a shared central authority, and there is loss of national monetary sovereignty. So an example will be the Eurozone. That's the countries in Europe that use the euro. As far as advantages of the currency union monetary system, there's the elimination of exchange rate risk within the union, right? And there's deeper economic integration. Now, the downside is that there's difficulty in managing asymmetric economic shocks, and there's limited policy flexibility for individual countries. Let's now look at dollarization or euroization monetary system. So here, a country adopts another country's currency as its legal tender, as its currency. So the key features would include no independent monetary policy for such a country, right? And this is often the monetary system used by smaller or unstable economies. Examples of countries rather, that use the dollarization or euroization monetary system would include Ecuador. So Ecuador uses the US dollar. And then we have Kosovo, which uses the euro. Now, as far as advantages are concerned, we have currency stability as an advantage, obviously. And there's credibility also, because they are using this well-recognized and credible currency, such as the US dollar or euro. As far as the downside, it's pretty much that the country has no control over its monetary policy. Let's now discuss balance of payments. Now, the balance of payments, that's BOP, is a statistical record of a country's international transactions over a period of time, presented in the form of double entry bookkeeping. Now, it includes trade in goods and services, cross-border investment, and transfers. The BOP directly affects supply and demand for a country's currency, which in turn impacts its exchange rate. That's the value of the currency relative to other currencies. Now, it's important to study the balance of payment for the following reasons. First, it provides detailed information concerning the demand and supply of a country's currency. It may also signal a country's potential as a business partner for the rest of the world. And balance of payment can be used to evaluate the performance of the country in international economic competition. Let's now discuss balance of payments accounting. Now, any transaction that results in a receipt, that is an inflow from foreigners, will be recorded as a credit with a positive sign in the balance of payments. It increases the demand for dollars and the supply of foreign exchange. And on the flip side, any transaction that gives rise to a payment to foreigners will be recorded as a debit with a negative sign on the balance of payments. And as a result of that, we'll see an increase in the supply of dollars and the demand for foreign exchange. So let's now look at the different types of balance of payment accounts. So international transactions can be grouped into the following four main types. You have the current account, which includes the export and import of goods and services. Then we have the capital account, which consists of capital transfers and cross-border acquisition and disposal of non-produced and non-financial assets. Then we have the financial account, which excludes official reserves. Now, financial accounts would include purchases and sales of financial assets, such as stocks, bonds, bank accounts, and such types of financial assets. And the fourth type of balance of payment account will be the official reserve account. And this covers purchases and sales of international reserve assets. So let's clarify what international reserve assets are. These are external assets held by a country's central bank or monetary authority that can be used to support the value of national currency, settle international transactions, and ensure financial stability during balance of payments crisis. Now, they serve as a buffer to help countries manage exchange rate volatility, to pay for imports, and maintain confidence in their financial system. So some of the key characteristics of these reserve assets would include it being highly liquid, so they are easily convertible to cash or other currencies. They are safe, there's low risk of loss in value, and they are widely accepted. So they are trusted in global trade and finance. So examples of official reserve accounts will be foreign currency reserves, such as holdings of foreign currencies by a central bank in US dollars, euros, or the Japanese yen. We could also have gold reserves, physical gold held by a central bank, such as bars stored in national vaults or abroad. Now, other reserve accounts would include highly liquid foreign assets like bonds or deposits held abroad, such as US Treasury securities and foreign central bank deposits. Let's now discuss the effect of balance of payments on currency exchange rates. Now, balance of payments is a comprehensive record of a country's economic transactions with the rest of the world over a specific period. It includes trade in goods and services, cross-border investments, and transfers. The balance of payment directly affects supply and demand for a country's currency, which in turn impacts its exchange rate. Now, the balance of payments reflects the flow of currency into and out of a country. A surplus, that's a balance of payments surplus, generally strengthens a currency due to increased demand, while a balance of payment deficit weakens a country's currency by increasing supply or reducing demand. Now, investors, traders, and governments closely watch balance of payments trends to gauge currency performance. Again, investors, traders, and governments pay close attention to balance of payment trends in order to gauge the performance of a country's currency. Continuing our discussion of the effect of balance of payments on currency exchange rates, we will now look at first the current account balance. The current account, again, records trade in goods and services, income from investments, and current transfers like foreign aid or remittances. Now, there is a current account surplus if exports exceed imports into a country. Now, a current account surplus would imply higher demand for a country's goods and services, which increases foreign demand for its currency to pay for exports, and this strengthens the currency. Now, on the flip side, a current account deficit implies that imports into the country exceed exports out of the country. So there is more domestic demand for foreign goods or services, which increases demand for foreign currency when there is a current account deficit, and this weakens the domestic currency. Let's now consider the capital and financial account. Now, this includes foreign direct investment, portfolio investments such as stocks and bonds, and other financial flows. Now, capital inflows are investments coming in, and foreign investors buying domestic assets must exchange their currency for the local one. And this increases demand for the local currency, resulting in appreciation of the domestic currency. So that's for capital inflows, that's investments coming in and its impact on the currency. And it is a currency appreciation effect. Now, on the flip side, for capital outflows, where you have domestic investment abroad, domestic investors would need foreign currency to invest abroad, obviously. And this increases the supply of the local currency, thereby causing the local currency or the domestic currency to depreciate. Now let's look at foreign exchange reserves and central bank activity. Now, central banks may buy or sell foreign currencies to stabilize or influence exchange rates. Now, if the central bank buys local currency, it's supporting the currency, and that results in an appreciation of the domestic currency. Now, if the central bank sells local currency, that results in depreciation of the domestic currency. And let's now look at speculation and expectations. If investors expect a balance of payment deficit, and especially if they expect or forecast persistent current account deficits, they may lose confidence in the domestic currency, and this could lead to capital flight and currency depreciation. Now, on the flip side, expectations or forecasts of strong balance of payment performance will attract investment and demand for the currency, resulting in currency appreciation. And the last balance of payment effect on currency that we'll consider is external debt and debt servicing. Now, high levels of external debt can weaken a currency, especially if the country struggles to meet its debt payments. Now, servicing foreign debt requires converting local currency into foreign currency, and that puts downward pressure on the local currency, causing depreciation of the domestic currency. I hope you have enjoyed the foundational topics in international finance lesson. I look forward to delving into other areas of international finance with you in subsequent lessons.